So that's where we were. Let's talk about where we are. Lots of different things here. So is there anything I should add to this list that anyone has a question about? American economy, tightening, easing, low prices, or fiscal policy? Okay. Sort of in the monetary policy area. Anything else? Okay. Yes, Banu. China. Okay. That's actually in the, well, it's there. Slower growth in China. Okay. All right. Did anyone watch this? We'll start with a little bit of humor. Anyone watch this? No one watched this? Gangnam, really? 2 billion people watched this.
Oh yeah, the original one.
Yeah. 140 million hours spent on this thing. So I'm wondering, did people watch this at home or at work? When I saw the statistic that 2 billion times and 16 million years spent, I wondered, what's that done to our productivity? That and just YouTube in general. Because I watch TED Talks, and I sit there with my son and watch music videos and things on YouTube, and holy cow, what is that? How many hours a day does that take? So we just ran a little bit of math here. 16, what is that? All those years. You could have built 20 Empire State Buildings, 6.5 Burj Khalifas, Stonehenge. Great. We could have done so much better things than watch that video. All right. No more humor. Okay. We're recovering, but we said this earlier, right? The average person in the economy doesn't feel the recovery. This is, again, an instance of asset price inflation based on QE that supports asset prices, right? So we made a decision that we wanted to bail out banks and support people that had assets, and that's what happened, with the idea, and this is just traditional, it would trickle down. And it has trickled down a little bit, and it's trickling down a little bit more, and now is the point when you hope it's going to sort of flood, right? Employment is the last thing. It's a lagging indicator. So we hope that happens. But there are so many big bubble problems out there that it could never happen. And that's the part that's really kind of terrifying. Okay. And actually, unemployment is now 5.8. We're thinking probably by middle of this year, it'll hit 5. So employment is coming up. But part of that is this. That's the participation rate. So everyone know what a participation rate is. These are the people that want a job or have a job. These are people that want to be part of the labor force. So it's been in decline, but should that be a surprise? Not really. Like, we have the baby boomer generation retiring right now. And I'm assuming that there's some people that, they were 62, 63 on the early part of that retiring, and they said, you know what? This is a miserable economy, I'm done. I'm not going to work an extra 3 years, I'm not going to boost my pension a little bit more, or I have enough to worry about it, I'm done. I have clients who are late 50s, early 60s, who retired, not for that reason, but because they want to do something else. They wanted to sell hardware, just because that's what they loved. They wanted to work in a hardware store, or want to do something like that, which I think is fantastic. But, they're not taking a great job or anything like that. They've reduced tax load, they've reduced all kinds of stuff. So probably the participation rate decline demographically should just be like this, but it should do that. It should be in decline right now, and we should expect it to continue to decline. Okay. So we talked a minute about, and I heard some groans when I said real wages are actually slightly positive. So this is the last 10 years. This dark bar is 2004 to 2008. The light blue bar is 2009 to 2013. 2 different 5-year periods. And so we don't have it that bad. Like 2004 to 2008, we had very strong earnings wage growth. Real, this is after inflation, so this is a positive. These are gains, real gains. Just teeny tiny gains here, but look at this. Look at Italy, Britain, Spain, and Portugal. Solid here, really, really negative here. So this, again, when you look at what the CFOs are saying, they're saying that they can't find the right people, they've got to boost wages, so this is that lagging indicator. We should see that increase and get better. So this is interesting right here. Prices are going up, and my house is fully recovered. Most people here in the Bay Area, the houses are fully recovered. But home ownership rates have fallen. So again, let's go back. 2008 happens, we have a lot of money flooding in. Where's the money go? Who loses? The people that bought their homes on too much debt, lost the homes. Who owns the homes now? A lot of banks still own homes. A lot of investors. One of the largest hedge funds created in 2009, they raised hundreds of billions of dollars to buy single-family homes that were in foreclosure. And they would buy, I have a friend in Berkeley who is a developer who manages real estate, who sort of went to Mechanics Bank and said, hey, we'll buy everything you foreclose on, we'll buy it, you know. And he's got a group of people that are doing that. So the houses aren't owned by the individuals anymore. They're owned by hedge funds and hedge fund groups and investment groups, and they're renting it out. And that's good. We're going to start seeing some of those sell back, though, as you know, prices are coming up, and now those people that bought them on cheap are going to start selling them. They're going to see the gain in their investments. Remember, this was never going to go away, but the deficit is totally in controllable space now. The debt is the thing that's scary. We have a high debt. So if we have to have a growing economy and a reasonable deficit for some period of time so our debt is in control relative to GDP. The risk or the danger is, what if rates go up? If rates go up and Republicans are in Congress, and we're not going to see tax increases. So if rates go up and that eats into the federal budget, what are we going to spend? Where are we going to pull that money from? Roads, schools, that's where the money's going to come from. You're going to remove money from other places because you have to pay the interest on the debt, right? So it's a trade-off, okay. And here we see the Fed supersized. It basically owns these long-term treasury purchases. So the Fed's intentions, and there's a line right here at the very end. The committee now expects this to occur. They're going to sell some of the assets on their balance sheet after the initial increase in the target range for the federal funds rate. So the target range is 0 to 0, right? That's the Fed funds rate target. And so what they're saying is, we're going to keep our balance sheet intact. We're not going to sell anything until we start raising that Fed funds rate.
Until we start raising?
The Fed funds rate. When they start raising rates, after that, it doesn't say how long after that, it just says after that's when they're going to do it. So we're pretty confident that they're going to continue with QE for quite a while. They're going to continue reinvesting in their QE for quite a while. Okay. And here's why. So about 4 years ago, we talked about this, and we were I don't know, right but early, wrong, I guess. So we talked about the idea that this is going to be a currency devaluation battle. So the person that can devalue the currency the fastest will have the fastest economic recovery. And that's exactly what happened, right? Because the US's goods on a global scale are cheaper when the dollar is cheap, right? So we're able to export more, our trading partners like us more, we're in better stead, except everyone else on the globe has suffered, except for maybe Japan and England, because they've also devalued their currencies through QE, through reducing rates, okay? So now we're stopping that. We've ended formal new bond purchases. We're now reinvesting our dividends and interest. Bank of England, and we're talking about raising rates. Bank of England is considering raising rates. I don't know if you guys saw this week. The European Union did a $1.2 trillion QE. So 2 years ago, and for 2 years hence, Mario Draghi said, we will do whatever it takes. Remember that? So the European markets took an absolute dive. Mario Draghi came up and said, we will do whatever it takes. The market stopped diving, went back up. Whatever it takes was nothing for 2 years. He did nothing. His word was enough. But now we have serious deflation problems coming. So what are we going to do? We're going to do QE. We're going to drive down the value of the currency. So in expectation of this, for the last 6 months, what's been unexpectedly strong? Anyone know? The dollar. Shockingly strong. And it's probably going to get stronger. How does that affect our corporations around the world?
The value of their earnings overseas goes down.
And how much of those, remember those big companies that have done so well on the top of the S&P, that have led for the last 3 years? How much of their earnings come from overseas? 50%. This is not good for that top half of the S&P that drives the S&P. It's not good at all. However, in the last 2 or 3 years, so we have slowly but steadily paired out of those companies and been buying into Europe and buying into emerging markets. It hasn't treated us well in this interim period. We have not done well because of that. But you can't say, okay, it's going to happen tomorrow, sell it all and buy. That doesn't work. So we've slowly taken risk off the table in the US and slowly put it to work in the emerging markets in Europe. And now we have a pretty good position in Europe and in the emerging markets. So when that dollar keeps going up and those companies in the US have problems with that, we're investing in these other ones. And so far, since QE started there, that's worked out. In the next 6 months, we expect that to work out even better in our favor. So US is ending QE, Europe is beginning QE. So while US had QE, markets went up. While the Europe didn't have QE, markets were going down. That reversal, there's a phrase, don't fight the Fed. And that's absolutely worked in the last 5 years, don't fight the Fed. At the same time, China, Japan is devaluing. They're trying to fight, they have a different problem. They have a 30-year problem, 25-year problem. And China is going to, they've been stimulating on a little bit here and there. They've actually reduced rates for the first time in a couple of years. Okay. However, we still expect slower growth in China. And, well, the strategists and the economists expect slower growth in China. As how could it not be? You can't grow at 8% forever. So, okay, here's the second place we're going to spend some time. We're going to talk about the commodity cycle. So there's three laws in investing, only 3 laws. When interest rates go up, bond values go down. Law number 1. It's mathematical, okay? Second law, not as mathematical, but over time this is true. Equity prices follow earnings. Over long periods of time, nothing else matters. Global, the economy, earnings. Equity prices, earnings. This is the third law, okay? So the supply-demand price relationship in commodities is a cycle. It is third law in investing. So we had $100 oil. At $100 oil, every producer on earth wants to produce more oil. So we get a supply goes up. Producers want to cash in on $100 oil. Supply goes up. What happens to demand? Price is too high. We all drove less. That's true in the data. We drove less, we used less energy. And then, so now we have producers coming online, lots of supply, and demand goes down. What happens to price? Price goes down. Okay, what happens when price goes down? Demand goes up. And if demand goes up and price is down, what happens to production? Goes down. So now production is going down. We're shuttering, we're mothballing a lot of these development facilities where the cost of getting the oil out of the ground is more than $50 a barrel, actually more than $40 a barrel. Because why would you you cap it and you wait till it goes back up? And so they'll do that. They'll cap some of these oil wells and they'll wait till the price goes back up to 60, 70, then they'll uncap it and then they'll start producing again. The cycle it's again, another iron law of finance. So what $50, $45, or $40, or $30, I don't know where it ends, but what that does is it takes production online and it makes us, and this is the most interesting fact, we've responded as a culture so quickly, SUVs are selling again. As a percentage of total car purchases, SUVs are being purchased, and Tesla stock is in the toilet. Like the one company that could, that's interesting. We have already as a culture responded in a 3-month period to gas prices going from $5 to $2.50. It's incredible how quick it is. Okay, and then I've got like 6 slides on oil. I'll go real quick through this. The US is now the biggest producer, or was. We're gonna stop a lot of the production. In 2013, our production went up 11%. That's huge. 2014, it went up again. In 2015, I'm gonna guess it's gonna go down. Our production is gonna go down. Saudi Arabia had a chance to say, and OPEC had a chance to say, nah, we're gonna stop production. They had a chance to dry up some supply. Why didn't they do it?
They want to drive us up.
Right. Like they want the other producers to exit, and their oil is valuable if they can sell it for 30. So they still make money. They don't make as much. Like obviously you'd rather sell for 100 than 30, but most of the oil that we're pulling out isn't valuable until it gets to 50, and most of that's not valuable until it gets to 80. So it gets to 120, then we start seeing fracking and horizontal drilling and all that kind of stuff. But at 50, we won't see that. It doesn't make as much sense. It's too expensive. Okay. There's a lot of winners and losers. Saudi Arabia, Russia, Emirates, These are producers, exporters. They're going to lose in this. We're still a net importer. We still use a lot of energy. These folks are all going to win. We'll get some specific numbers here in a second. So China, this is an interesting number. For every $1 decline in a barrel of oil, $2.1 billion a year. So they just saved $120 billion a year. That's a huge China stimulus. Europe, not as big a deal. Their problem is it's going to create more deflation when oil falls. India wins big because of their imports in oil. Saudi Arabia, it's obvious, we talked about it. This one's interesting. Venezuela has banked their spending, their financing, they've banked it on $120 oil. So what does this mean for us as investors? Not so much in Venezuela, because no one buys Venezuelan bonds anymore, because it's 4 defaults in the last 20 years. But Russian bonds, there's a lot of Russian bonds out there. And, okay, here we go. Let's look at that. 15 years of growth, but now they may be entering serious problems, because oil at 120, they're selling their oil at, Putin doesn't have, and he's a crazy man to begin with, right? So we don't know what happens there. But look at this, Iran, $136 a barrel. So these two folks here, not good actors globally, both dependent upon oil. That's their chief export. That's that's dangerous right there. Okay. So this is what we just talked about. Congress renewed funding, so no shutdown. They also, at the very end of the year, they did extend the tax cuts. So usually there's a basket of tax cuts that are good for teachers and for small businesses and for big businesses. And this year they waited until the end of December and they extended them for last year. But they didn't extend them this year. Usually they give us a couple years. This year, not so much. They gave us a week to make our tax change, right? And they didn't change it for this year. So again, this year we're going to wait probably till the end of the year to know whether those tax cuts are going to be, or those tax benefits are going to be there for us. But we still have April 15th, May, and then we have August and November that are difficult days that Congress has to do something. How do you think that's going to work? It's just everyone shakes their head.